evening. News that the Bank of England's Monetary Policy Committee voted 9-0 to leave UK interest rates at 4.75% seemed to have little effect on UK investors today. London blue chips made gains in early trade following good trading news from heavyweights Vodafone and Prudential and a strong performance on Wall Street. European stock markets were volatile as downside pressure came from T-Online after Deutsche Telekom declined to sweeten its share repurchase offer. For more on that and an expert's view on trends in global markets, we have in studio Nicole Elliot, technical analyst at Mizuho Bank. Welcome to the show, Nicole.
Well, thank you for having me.
We've been looking at all the telecom sectors doing really well in European markets. Now, but looking at the fine print, it would seem that they're cutting back on profits to try and get more customers. Now, if competition is so fierce, does that mean European markets are very saturated?
I think competition for all corporates is going to be absolutely wicked. It was bad last year and it's going to get worse. I mean, you've got all sorts of things moving against you. Oil prices going up, pricing power coming down. You know, the only thing that they're managing to keep sort of steady are wages, really. But yes, it's absolutely lethal in all sorts of sectors at the moment. And this is just another one. It's tough out there, very tough.
So the FTSE is well done. It's closed quite high, actually, high-ish.
Ish, I'd say, Sucharita. It's up one day, down the next, you know. I mean, I wouldn't get too excited. The main thing for the stock markets, I think the main feature we must take on all of them this January is that we have undone some of the silly froth that we saw in December. Thin markets in December, this is so often the case. We go and get too excited, we go up too much. And that's what we've seen in January, pulling back, undoing some of the excesses of December. Now, looking forward, I think what's going to happen in most of the major indices is that we're going to consolidate below December's high for the next 2 months or so. I think the whole of the first quarter in many markets will be one of consolidation, getting our bearings again, working in a range, establishing a new trading range, and that's what we're doing at the moment. That's why it looks a bit boring, as I say, up one day, down the next.
If you look at the charts now, a one-year graph of each of the indices, the three, FTSE, the DAC and the CAC, three main ones, do you think they're performing differently or are they quite similar?
I'd say the European ones are fairly similar and there's not much in between one or the other. I mean, the thing you have here is that while the prices may have not gone up too much, because sterling and the euro have gained in strength, you've actually got a positive return on the on whatever, you know. Whereas in the States, you know, you may say the indices have gone up, but with the dollar weakening, particularly over the last 3 months of last year, you're actually down. As a European investor, you're down on those. So I'm not very inspired about them at all. I can't get terribly excited.
And nothing particular about the markets. I notice if you look at a year's graph of the DAX, it seems to be, you know, peaking and
that's right. I mean, we're up from the lowest levels that we've seen. We're well below the all-time highs. So it's sort of a bit pig in the middle, isn't it? Neither one nor the other. Glass half full, glass half empty.
Right. Well, we had a look at the European markets. You've got really interesting views on Mumbai's Sensex. So I've got a 5-year graph for you. I mean, could you tell us what your projections are?
Right. This is again based on technical analysis, and it's one of the few stock markets that is really going somewhere, is really doing something interesting. Now, again, like the others, we've pulled back quite sharply in January. Obviously, the higher we go, the bigger the pullback. That's what's happening at the moment. But the key here is that the Sensex closed above 6,000 for the first time ever in 2004. That is a major break higher. So over the long term, I think this could go significantly higher. Again, as I say, other emerging markets have pulled back in January. This one has got a true underlying major bid. We're working towards completely new levels. Jakarta is actually leading the way. Jakarta is showing us which way we're going. And this one, I think, over the medium term, I think we'll trade below 7,000 all for most of this year. But in the third quarter, I think we could easily hit 7,000, which is a new all-time high. And long term, I see no reason why we couldn't hit 7,500 very late this year, early next year.
Nicole, we have a question from you from our studios in Delhi. Vikram,
Right, so Charita, naturally what she was just, we are just hearing right there has got us all very excited out here. Just wanted to check, when you are saying that you think the Sensex is in uncharted territory and heading significantly higher, just what sort of levels are you talking about in the next couple of years? What are the charts at any rate indicating?
That's right. I think there's two things. I mean, from my charts, I'd say 7,500 is a very realistic target. This assumes that other stock markets around the globe do not collapse this year, that basically they stay moving sideways at best, up if we're lucky. Obviously, if around the globe we have a stock market crash, then we'll have to think again. But this is one of the few that's really got a good bid to it. And I think one of the things that will help it along is the interest rate environment. I mean, interest rates in India, the treasury rates have come down an awful lot over the last 10 years. They've now moved up last year, but I don't think they'll keep on doing this. I think they're going to stabilise. I mean, the 5-year treasury bond, for example, I think should trade most of this year between 5.8 and 6.8%, with a small chance of a dip to 5.5 and a move up to 7. But most of the time you can factor in a midpoint around 6.2%, and that I think will help business along, knowing that that's what they can price in.
I just wanted to check the pullback that we are seeing in the Sensex right now. Is it your view that even in India we are undoing what you were saying a short while back, some of the froth of December? And do you see even in India that process continuing for another 2 months or so, the undoing of the excesses of December?
I think we've undone most of the excesses. I don't think we've undone all of them, but most of them are probably already in place. I expect the Sensex to try and base in February and in March somewhere between 6,000 and 5,800. That's the sort of level. Take your time. I don't think there's any need to rush in right now. As I say, you've got at least the first quarter of consolidation and mucking around and just establishing a range. Once we're happy, once I am happy with that range, then I think it's definitely time to buy for the move that I mentioned earlier.
And when that move does come, it is your view that India is not going to move in line with emerging markets. You think it's going to significantly outperform other emerging markets?
Oh, I can't say all of them. I don't know how many we're going to compare it with, but I think it could probably do better than something like the Brazilian Bovespa, and it could probably do something better than the Argentine Merval, but I don't know about all the others. I can't say for all the others.
Nicole, I mean, just to pick up on Vikram's point, at the moment, do you think the Indian market is slightly overpriced? I mean, we've seen over the last few weeks, a lot of the foreign investors have been pulling out. Is there any particular reason or cause to panic?
I don't think so. I think this is one of the better ones. As I said, there is a small chance that all equities could have a terrible year this year. There is that small chance, but I think the Sensex has an underlying bid. It'll do better than many, and therefore I'd be plumping for this one rather than the others.
I'll move you quickly onto currencies. Nicole, I know you have very interesting views on where the dollar is going. Some people say that central banks, well, especially Asian central banks, are getting nervous about their dollar holdings and are looking at the euro. Do you agree with that?
I don't think it's time to get nervous. I mean, what we do have is the trend to a weaker dollar and a stronger euro is mature. I mean, let's face it, the euro hit all-time lows some years back. So it's a good 3 years. So when we're talking about currency moves, be aware that the bulk of the move has probably taken place already. Now, that doesn't mean to say there isn't more, and I'm probably one of the most bearish on the US dollar, most bullish on the euro around, so take whatever I say with a pinch of salt, because I'm at one extreme end of the spectrum. But definitely I think there's more to the euro. Again, the euro, like the stock markets, for the first quarter of this year should consolidate below the all-time high at 136.70. I'm looking for it to base between 130 and 126 to the dollar. Again, take your time, no need to rush in. But at those sort of levels, I think it becomes interesting again. And I'm looking for the euro at the end of the year to be about 149 at the end of this year. So not massive gains, but steady gains.
Would you like to make a longer-term forecast for the dollar?
At the moment, I'd say I'd rather only stick to 1 year because the move is so mature. And my only doubt at the moment is whether the dollar will deteriorate steadily or whether it could go into free fall. That is what I'm really concerned about. So one way or another, I'm selling dollars throughout this year. It's just a question of the speed of the move that I'm a bit not sure about.
And for our viewers, you have you've made some forecasts about the rupee, haven't you? Here's a 5-year chart of the rupee versus, well, the dollar versus the rupee.
That's right. Amazing. I mean, like many other currencies, the rupee has been strengthening against the US dollar. Here we have how many rupees do you need to a dollar. And as you can see, it's been getting stronger, like the others. Not the best performer, not the worst. I think the rupee strength is probably about to slow down or end very shortly. I think it'd be very difficult to go under 40 rupees to the US dollar, whatever happens this year. But again, by the same token, I think we've got a cap at 46 rupees at the moment. So a lot of toing and froing between 40 and 46 rupees this year.
Nicole, I don't want to interrupt, but I mean, what is this really based on? I mean, why will the rupee, lose value?
Not lose value. I think it's just sort of stable, and again, it's to do with the interest rate scenario. It's that sort of in a band rather than trending. It'll trade in a band, not a straight up as we had from the last 10 years, not a straight down as we've had in the last 2 years. It's that sort of move, that sort of feel to it.
And do you think rising, US interest rates will sort of stop the cash inflow, foreign cash inflow into India?
Well, I'm on two minds. Are US rates rising? Mr. Greenspan is carefully putting up the Fed funds rate to a grand 2.75% at the moment. But in precisely the last 6 months, the 10-year bond yields, which are far more important to US business, US house owners, everybody, I mean anyone who's doing business in the States, is based on the 10-year Treasury, and that is marching completely the other way. And I'd say that the US interest rate might go up a little bit more now, but look at the long end. That's what's telling you what's going to happen later on.
If you look at, say, commodities now, I mean, the stock markets globally are quite, dull, nearly. There's not much movement. Do you think commodities are what we should be looking at this year?
Very much so. I've been looking at commodities for 2 years now. I think they're in a major cyclical uptrend. They're really exciting, most exciting than they've been in the last 10 years, and it shows. I mean, particularly metals. Those are the ones that are leading the way. Not so much precious metals, base metals are leading the way, but also it's having an knock-on effect on a lot of other things. Now, one of the reasons they are in an uptrend is that most of them, the wholesale markets, are denominated in US dollars. So if the dollar weakens, then just to keep the thing on the same price, it's got to go up a bit. So that's what we've been seeing. I mean, I see we've got a chart here of gold, and you can see that we have been steadily rising. Yes. We've had a pullback like the others in the last quarter. It all got a bit silly. We've had a pullback both in dollar terms and in the real price of gold. I think we're basing on this one again, and I think we should get up to $500 at the end of this year.
Nicole, we're running out of time, so I want you to sort of, quickly run through oil. I mean, oil is what's affecting markets
It's
globally.
going to affect us all, and it's getting more expensive. End of story. Rather like the gold, it pulled back, we found a base, we're on our way up again. We're struggling here at the moment, $45 on Brent, and below the recent high. I think we're going to have a lot more sideways work this quarter, but then we go up again.
And so where do you think it's going to settle at roughly?
My prediction for Brent is $64.50, a high this year. Again, assuming that the US dollar does not go into free fall. If the US dollar goes into free fall, then it could be a lot more than that. But I think $64.50 is a realistic target on Brent crude.
Okay, thank you so much, Nicole. That was Nicole Elliot with forecasts on investment options for. And that's all from us today. Tune in tomorrow at the same time for the daily business update from Europe. Good night. Thank you.